Ever wondered how the future of our economy might look like? What if the year 2024 brings a recession? What signs should we be looking for? As we navigate through the labyrinth of economic forecasts and predictions, one word often sends chills down our spines: recession. But what exactly is a recession? In the simplest terms, a recession is a significant decline in economic activity that lasts more than a few months. It's like the economy catches a cold, and if not treated, it can turn into economic pneumonia. When a recession hits, it affects everyone, from the top echelons of Wall Street to the average Joe on Main Street. It can lead to job losses, decreased consumer spending, and a general sense of financial uncertainty. Understanding the early signs of a recession can help us brace for the impact and make informed decisions. Today we're going to explore 6 signs of a recession. So buckle up and let's dive in. Firstly, let's talk about unemployment. When jobless rates start to climb, it might be a sign that a recession is on the horizon. Now, unemployment isn't just about numbers on a chart, it's about real people losing their jobs. It's about families struggling to make ends meet. And when unemployment rates start to rise, it's a sign that our economy may not be as sturdy as we'd like to think. So, why does unemployment matter so much? Well, it's simple really. When people have jobs, they have money to spend. And when they spend money, businesses thrive. But when unemployment rises, fewer people have money to spend. This can lead to decreased demand for goods and services, which can then lead businesses to cut costs, often resulting in even more job losses. It's a vicious cycle. Let's dive a little deeper. Unemployment rates are closely tied to economic stability. When the economy is doing well, businesses hire more employees to meet increased demand. But when the economy starts to falter, demand drops. Businesses may start laying off workers, leading to an increase in unemployment. Now let's bring some facts and figures into the picture. Historically, we see that unemployment rates often begin to rise before a recession. For instance, in the early 90s, jobless rates began to climb a year before the recession of 1991. Similarly, in 2007, unemployment rates started to rise, preceding the Great Recession that began in 2008. But it's important to note that rising unemployment rates alone don't necessarily signal a recession. Other factors such as consumer spending and stock market trends also play a significant role. So, while we should pay attention to unemployment rates, we must also consider the broader economic picture. So, a surge in unemployment rates could be a red flag, but what's next? Next on the list is consumer spending. When people tighten their belts, it's often a sign of troubled times ahead. Now let's talk about the correlation between consumer spending and economic health. Imagine the economy as a gigantic, high-powered engine. The fuel that keeps this engine running smoothly? That's right, it's consumer spending. It's no secret that we live in a consumer-driven economy. When we're feeling confident about the future, we're more likely to splurge on that new car or book a dream vacation. These purchases pump money into businesses, which in turn can hire more employees, invest in new products, and contribute to economic growth. It's a virtuous cycle that keeps our economy humming along. But what happens when we start to worry about job security, or when our credit card bills get a bit too high? We tighten our belts, we postpone that vacation, or decide to stick with our old car for another year. And when everyone starts doing this, businesses feel the pinch. They may have to cut back on hiring or even lay off workers. This can lead to a vicious cycle of decreased spending and economic contraction. In essence, consumer spending is like a canary in the coal mine for economic health. When spending is robust and healthy, the economy tends to follow suit. But when spending starts to falter, it often signals that a recession could be on the horizon. Therefore, when consumer spending slows down, it's time to pay attention. Moving on, let's look at the stock markets. When they start to tumble, it could mean a recession is nearing. Now, the stock market is like a barometer of economic health. It's a reflection of how businesses are doing, and by extension, how our economy is doing. When companies are profitable, their stock prices rise, attracting more investors, and the market thrives. But when things don't look so rosy, investors might get jittery, sell off their stocks, and the market begins to falter. So, how does a falling stock market signal a recession? Well, it's about investor confidence. If investors believe the economy is going to do well, they buy stocks. If they think it's going to do poorly, they sell. A mass sell-off can cause stock prices to plummet, which might indicate that investors are bracing for a rough economic period ahead. However, it's important to remember that the stock market isn't a crystal ball. It doesn't always predict recessions accurately. There have been instances where the market has crashed and no recession followed. Conversely, there have been recessions without a preceding market crash. Yet, despite its imperfect track record, a falling stock market is often a red flag. It's a sign that investors are nervous about the future of the economy. And when investors get nervous, it can lead to less investment in businesses, which can, in turn, slow down the economy. So a falling stock market is another sign to watch out for. Now let's talk about business cycles. When they start to contract, it's typically a sign of an impending recession. Picture this. The economy is a living, breathing entity. It has its good days, its bad days, and everything in between. This is what we call the business cycle. Periods of economic expansion, or growth, followed by periods of contraction, or recession. It's as natural as the changing of the seasons, but with a lot more zeros on the end. These cycles aren't random. They're driven by a multitude of factors, like changes in consumer confidence, government spending, and global events. Think of it as the economy's mood swings, if you will. When the economy is feeling confident and bullish, businesses are expanding, jobs are plentiful, and the stock market is rising. This is called an expansion phase. But what goes up must come down. After the party comes the hangover. Enter the contraction phase. This is when the economy starts to slow down. Businesses become cautious, job growth slows, and the stock market may start to tumble. And if this contraction continues for an extended period, we find ourselves in a recession. Now you might be thinking, okay, so the economy is a bit moody, but how does this help me spot a recession? Well, one key factor to watch is the length of these cycles. Historically, expansion phases have lasted around 5 years, while contraction phases have been far shorter, usually around a year. If we start to see the expansion phase shorten and the contraction phase lengthen, it could be a sign that the economy is heading towards a recession. It's like seeing dark clouds on the horizon. It doesn't guarantee a storm, but it's a good idea to pack an umbrella. So, a contracting business cycle could be a clear warning signal. But remember, it's just one piece of the puzzle. It's important to look at the big picture, considering all the factors we've discussed, before concluding on the mood of our economic beast. Finally, let's not forget about the yield curve. When it inverts, it's often a sign that a recession could be coming. But what exactly is this yield curve, and why should we keep an eye on it? Well, in the simplest terms, the yield curve is a line that plots the interest rates of bonds having equal credit quality, but differing maturity dates. It's a financial tool that gives us a peek into future interest rate changes and economic activity. Typically, a healthy yield curve slopes upwards, reflecting higher interest rates for 20 or 30-year bonds compared to short-term bonds like 2 or 5-year ones. This is because investors expect a better return for locking their money away for a longer period. However, things get interesting when this curve inverts, meaning the interest rates on short-term bonds are higher than those on long-term ones. This unusual situation is often a harbinger of economic downturns. Why? Well, it indicates that investors are expecting a dip in the economy and are choosing to invest in long-term bonds, driving their yield down. Think of it as a game of musical chairs, where everyone is scrambling to grab the safest seat before the music stops. Of course, an inverted yield curve is not a crystal ball. It doesn't guarantee a recession, but it has accurately predicted most of the economic downturns in the past 50 years. So it's definitely something to keep on your radar. So these are the 6 signs of a recession: rising unemployment, decreased consumer spending, falling stock markets, contracting business cycles, and an inverted yield curve. Keep your eyes open for these signs as we move into 2024 and beyond. And remember, just as a weather forecast helps us prepare for a storm, these economic indicators help us brace for financial turbulence. Stay smart, stay safe, and remember, knowledge is power.